Let's be real. Long-term care insurance, it has a reputation problem. Hybrid long-term care was built to fix it. So is long-term care actually worth considering, or is it just another financial product you'll never use? Let me start with a stat that stops people in their tracks. According to the U.S. Department of Health and Human Services, roughly 70% of Americans turning age 65 today will need some type of long-term care during their lifetime. So when we talk about long-term care, we're not talking about some rare situation that may not ever happen. We're talking about a probability that affects the overwhelming majority of aging families. And here's the real question. If that scenario shows up 20 or 30 years from now, how do you want your financial life positioned to deal with it when it happens? Because relying entirely on your investment portfolio to absorb those costs, especially for multiple years, it puts tremendous pressure on your asset, on your spouse, and on your legacy. That's where hybrid long-term care enters the conversation. You might be thinking that long-term care makes some sense, but why hybrid long-term care? What makes it different when it comes to premium? Let's start at the beginning. Traditional long-term care insurance has a well-known problem: rising premiums. Every few years, clients get a letter in the mail with the same message: sorry, premiums are increasing again. And the coverage can stay the same or be lower. Now, hybrid long-term care, on the other hand, it's a different design entirely. You can choose a single premium, a 5-pay, a 10-pay, or a short multi-year pay schedule. And once those payments are completed, you're done. No annual renegotiation, no open-ended premium cycle, no uncertainty about what the next letter in the mail might say. Hybrid long-term care gives clients clarity of cost, clarity of timing, and clarity of benefit. Okay, when then should you start the process when it comes to hybrid long-term care? The ideal time is in your 40s or 50s or even early 60s. However, people often wait too long to think about long-term care. But here's the reality. In your 40s and 50s, underwriting is usually much more favorable. In your early 60s, you're still within the window where pricing and health qualifications are generally attractive. But waiting until later often means higher premiums or health issues that will limit your options. So I always tell clients, the smartest time to consider long-term care is way before you need it, when your health is strong, when options are open, and when cost is much more manageable. All right, I think you got it so far. So let's talk about hybrid's premium structure. It's more definitive. You should start sooner rather than later. And you might be asking, what about the use it or lose it side of long-term care? Well, unlike traditional long-term care insurance, people like the hybrid approach because it solves a key psychological challenge. No one wants to pay into something that they may never use. Hybrid long-term care addresses that in 3 ways. If you need long-term care, the policy can provide significant leverage, often multiple times the amount of premium paid, to help reduce the pressure on your investment portfolio. Second, if you don't use long-term care, your beneficiaries can generally receive a death benefit with a little bit of growth. And third, if your plans change, many hybrid policies include liquidity return of premium features. So instead of thinking, what if I never need this? You start thinking, how does this help me any which way it may go with my health? Because it's no longer a use it or lose it proposition. So how does Puzzle Wealth use long-term care in planning? We do not design hybrid long-term care to cover every dollar of potential long-term care. That would balloon premiums and create unnecessary costs. Instead, we use long-term care as a complement to your investable asset, a way to absorb a meaningful portion of the cost so your portfolio doesn't take the full hit month after month. It creates stability, it creates optionality, and it protects the rest of your financial plan from being derailed. Sound attractive? Maybe your interest is piqued? Well, let's go through how the application process works. People often assume long-term care underwriting is painful. It's really not, especially with modern hybrid carriers. The process typically includes an application, a phone interview, a review of medical history, and sometimes records from your physician. But there's no invasive medical exam in nearly all cases. Most clients complete the process easily and are pleasantly surprised by how straightforward it is or was. Now, once the policy is issued, how do you keep track of it year after year? Well, annually, you receive a clear, simple illustration showing your current long-term care benefit, how much the benefit is projected to grow to ages like 75, 80, 85, and then how the benefits adjust over time. You always know where you stand. No guessing, no surprises. And then now what happens when the time comes that you need insurance? How are those benefits paid? Hybrid long-term care policies typically pay benefits on a reimbursement or cash basis depending on the carrier. But the key advantage, most hybrid long-term care begins paying from day one of eligibility without the long elimination periods common in older policies. This gives families immediate support during a difficult transition without needing to spend months meeting a deductible like waiting. So to bring this all together, why has hybrid long-term care become a core strategy for wealthy families? Well, when I walk clients through the numbers, the reactions are usually pretty consistent. They like the leverage. They like the tax-free benefit. They like the premium certainty. They like protecting their spouses from financial disruption. They like reducing strain on their investment portfolio. And they like, if they never use it, the policy still provides some value. Hybrid long-term care has become one of the most effective ways to manage one of the largest risks in retirement. Not because it eliminates the risk, but because it makes the outcome far more manageable. So if you're in your 40s, 50s, or early 60s, and you want some clarity, potential stability, and a plan that can reduce the pressure on your portfolio down the road, hybrid long-term care is worth a serious discussion. If this is something you want to explore, please use the link in the video description to book a Zoom meeting with me. We'll walk you through your goals, your health, and your options, and help you see whether long-term care, hybrid that is, fits into your long-term strategy or not. As always, thanks for watching our videos. It means a lot to me and I greatly appreciate for it. If you found this video helpful, please like it and subscribe for future videos. And please remember, stay proactive, stay prepared, and stay ahead of the decisions that matter most for your future.